Hello everyone and welcome back. Today we are going to talk about a portfolio update because I just sold Google stock to buy more Adobe stock. So I will share my views, the kind of allocation I have right now with Adobe because I've been buying for the past few weeks and I am continuing to buy because the situation is getting pretty attractive here. You have a pretty attractive risk reward ratio. So yeah, why not make the investment now? After some weeks, some months of research, I finally pulled the trigger on Adobe and I am building more conviction as I do more research. So this is the reason why I sold Google to buy Adobe. Okay, in case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 24-25% per year. And the goal of the portfolio I have here is to outperform the S&P 500, is to outperform the market. The portfolio is public, the portfolio is on eToro, the portfolio, anyone can have access to this portfolio every waking hour of the day. You just click the link in my description below. You have a link to my eToro. And before making this trade, I had Google as my biggest position, 15% of my portfolio. And it was the case because the stock had run up immensely in 2025. It was a big position, like 10% of my portfolio, but the stock went up so much that it had become the biggest position in my portfolio, and I was not comfortable having a rather high valuation for Google as a biggest position. I want my biggest position in my portfolio to be very safe. And now the stock has already doubled. A lot of euphoria is priced in. People argue that Google will rule over the world. And I see a lot of optimism for Google. And I don't like this at all, actually. So now we have a P/E ratio of 31, but you have to make some adjustments, I believe, when it comes to the valuation. So maybe you are following another YouTuber called Arya. Great work. Please subscribe to his YouTube channel. And he created this PE ratio formula if you exclude the investment gains, which means all the private investments they have. And I believe this is the correct way of valuing Google. And if you believe this is the correct way of valuing Google, the real PE ratio of Google is not 30, it's 40. So it's not cheap. It's maybe fairly valued. It's maybe a tiny bit expensive, but it's not cheap, okay? And from now on, investors that are buying Google are buying into euphoria. People know that the stock has already doubled. It's a winner from AI. The sentiment is very positive right now for Google. So I took some gains out of Google and I reduced the position from 15% of the portfolio and I cut 4%, now it's 11% of the portfolio. So I sold 4%, and the 4% were allocated to Adobe. Adobe, before this move, was 6% of the portfolio, now it's 10%. And I like it this way. I like a 10 by 10 portfolio. It was very rewarding to have this in the past, and I believe it will continue. So pretty happy with the trade so far. I believe Adobe is one of the most hated companies in the US right now, one of the most misunderstood companies in the US right now. Like all the SaaS companies, software as a service, the stock is going down because of worries from AI. And the key question is, will Adobe benefit from AI or will Adobe be disrupted by AI? And for quarters and quarters and quarters, Adobe showed no proof of integration of AI. And for the past few weeks, I have gotten more evidence than that Adobe is integrating AI everywhere. And instead of fighting with ChatGPT, for example, they are collaborating with ChatGPT. Instead of fighting with Gemini and Google, they are collaborating with Gemini and Google. So they are partnering up with everybody, integrating AI everywhere. They are creating a cheap alternative to Photoshop for free users, and they are putting AI everywhere, and they are starting to monetize their AI platform with credits. So seems like they are adopting this new AI wave, and so far it is working if you look at the fundamentals. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. But even if we have these early signs, people are not satisfied. People don't like what they see. So the stock continues to go down and down and down and down. For those who want to know my target price, I bought more Adobe at $333 dollars, and we will see how the stock will evolve over time. But for the first day of 2026, cheap companies, their stocks went up immensely, and all the software companies, their stocks went down immensely. So I made the trade during the first trading day of 2026. And if you look at the valuation, look at the P/E ratio for Adobe, lowest valuation in 10 years. It's a premium company, right? They have almost a monopolistic position for professional editors, for example. And they have very good management team, very good margins, very good growth. So it was always a stock that was trading at a P/E ratio of 40, 45, 40, 45, and now we are 20. So the sentiment is bad right now. Sentiment is very negative, but so far Adobe is not in panic mode, I would say. Is still surviving and still growing. Because if you look at the revenue growth for Adobe, yes, we are down from before. Before, in the past, the revenue was growing 20-25% per year. Now, growth decelerated since 2022, but this is still a business that is growing 10% per year. So for a P/E ratio of 20, this is pretty nice because the revenue is growing 10% per year. The margins are stable, which means all the revenue will be converted into profits that will be converted into free cash flow. So you have a business that can grow free cash flow at 10% per year. And they are using all their free cash flow to do buybacks, which means you can create a very, very simple DCF. I was using this website, Fiscal AI. If you want to use Fiscal AI, I have an affiliate link in my description. And it will get 15% cheaper. Literally, use my link. And now I will use Stock Unlock. Same thing, you have a discount code in my description. You can click on this link, register. I'm using these two websites on a daily basis. So literally, these are the best websites to use. And Stock Unlock has the best DCF tool. And let it load a little bit. If you think the free cash flow will grow 10% per year, this is what I told you before. And if you think they can do some buybacks, what is the buyback program right now? Right now, Adobe is buying back 5% of their shares. What if they continue at 5% buyback every year? And let's say the price to free cash flow stays the same. What has been the price to free cash flow over time? You will get a very simple way to value Adobe. You don't need to be an expert. You don't need to be a genius at all, actually. You can be very simplistic with your DCF model and be fine. Here is the price to free cash flow of Adobe. In the past, you can see that the price to free cash flow of Adobe was roughly 30, right? What has been the average? 32. Okay, and now we are the lowest price to free cash flow ever at 14. If we stay at this range, and let's say the price to free cash flow stays at 14, if you buy right now, today, the stock is undervalued by 30%. And if you buy right now, you can expect a CAGR, a compound annual growth rate of 15% per year. Right now, like today. What if the growth comes back? Because it can adopt AI and monetize AI. Okay, first lever that will move the stock up. Two, what if the valuation comes up again because the mood is changing. I mean, you know it too well, right? We talked about Google before. The AI sentiment is absolutely weak. People have no strong conviction in this market. People are weak, so you can benefit from this weakness. And for Google in 2025, Google went from an AI loser to an AI winner in 6 months. It can happen. I'm not guaranteeing a result. I'm saying it can happen. The valuation can shoot up to from 14 to 24, and people will say, "Oh, I missed it. Oh, so crazy." Well, it can happen, and it can happen fast in 6 months. So, what if the valuation comes back up a little bit? Maybe not to 30, price to free cash flow of 30. What if we go from 14 to 18? Okay, let's put this in our DCF. If you have a price to free cash flow of 18, then the stock is cheap undervalued by 60%. And if you buy right now, today, you can have a return of 21% per year. Seems like a very attractive risk-reward opportunity, especially compared to Google. Now, I know what people will say. Some people hate Adobe for good reasons. You have many reasons to hate Adobe. I completely understand this. Some people will say they will get eaten by competition, canvas, churn rate. Customers will no longer want to work with Adobe. AI will replace them. You can edit photos and videos on ChatGPT. Maybe not now very well, but in 3 years, you can edit everything wherever you want. Yeah, it's a scenario. Maybe in 3 years, you will be able to edit everything on ChatGPT, on Gemini. Maybe you will be able to change the light of your photos on Gemini for free. Maybe. It's a scenario that can happen. People think of this exponential curve and they think it will continue to be exponential. Maybe, maybe not. You saw what happened during the dot-com bubble. For the older generation that is watching this video, you know what happened. People expected the moon, and people saw the pace of innovation, and they expected exponential curve. Guess what? It started with an exponential curve, and then flatlined a little bit and went increased, but the growth rate decelerated. Okay, people expected to have the internet of 2015. They expected it to be here in 2005. So maybe you will not be able to edit everything on Gemini, on ChatGPT, in 3 years. Maybe in 10 years, okay? But there is a scenario, and I completely understand why people think like this. This is fine. What if the growth rate goes from 10% to 5%? And what if the price to free cash flow goes from 14% to 14 to 10? So let's look at the bear case here. If these are your assumptions, growth rate of 5%, buyback of 5%, and a price to free cash flow of 10, then the stock is expensive by 30%. And if you buy right now, you will have flat returns. So as a bear case scenario, this is fine to me. This is fine to me. I like the odds. Now you have to decide what is the probability that this negative scenario occurs. What is the probability that the base case scenario occurs? And what is the probability that the bull case, reacceleration bull case occurs? And then you decide. But for me, I'm buying. So yeah, quick update for you guys. I am selling some of my Google shares to increase my position in Adobe. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.